Good morning. This is Traderfirstyear, and this is the 4/12/2021 morning forecast. Markets are implying a move of 1.09% up or down on the S&P 500. Markets have realized a move of 0.77% up or down. The difference between what market makers are implying and what has been realized has increased. The spread widened to 510 basis points. The put-call gamma imbalance favors continued call buying. However, a tightening spread decreases left tail risk and reduces the potential for spikes in realized volatility. Realized volatility has decreased recently below 13. This is favorable for narrower and smaller moves up or down on the index. I expect a decreasing trend over the second quarter during April, May, and June. The current market environment is favorable for traders looking to sell convexity via short straddles, strangles, call overriding, put rights, and other short vol strategies to capture alpha. The MOVE index hovers around 65 to 68, or movement of 4 basis points daily in Treasury yields. However, economic growth, upgrades, and rising inflation expectations are pushing up real yields, which is raising discount rates. The rise in real yields could have a negative effect on long-duration assets, such as technology stocks and long-term bonds. The S&P is expected to move close to 1.22% up or down this week, which means the S&P could rise 16% or fall 13% above its 200-day moving average, which is 3,577.70. The S&P traded well above its 50-day moving average, which is 3,914.112 last week. The full year S&P earnings are expected to total $175 per share. At current prices, this puts the S&P at 23 times earnings, which equates to an earnings yield of 4.3% and an inflation-adjusted real earnings yield of 1.79%, using the 5-year TIPS break-even for inflation, which is currently at 2.51. Analysts are anticipating earnings in 2022 of $201 per share. At current prices, this puts the S&P forward earnings for 2022 at 20.4 times, or a yield equal to 4.9% and an inflation-adjusted earnings yield of 2.39%. Forecasters are rushing to upgrade nominal and real growth expectations for the full year in 2021. The highest number of private forecasters and those from the Federal Open Market Committee members are close to 7% on a real basis. If this rate of growth is realized, it would add $1.3 trillion of real output to the U.S. economy. The coronavirus subtracted 3.5% of real economic output from the U.S. economy in 2020. In 2021, the U.S. economy would need to grow at least 3.62% to break even on a real basis. For the first quarter of 2021, current estimates of nominal growth are $300 billion and real economic output of $130 billion. These forecasts have already been surpassed. The U.S. is on pace to generate a little under $500 billion of nominal economic output in the first quarter. At the current pace, if it held through the full year, would generate close to $3 trillion in economic output. While this is exciting, I do not expect this pace is sustainable or likely to culminate in those size gains. However, I do believe a nominal gain of 1.5 trillion to 2.2 trillion in economic nominal output is possible in 2021. Full-year economic estimates have increased significantly following the passage of stimulus. The median forecast was anticipating close to $1.2 trillion in nominal growth and $800 billion in real economic output for 2021. The current pace of nominal growth as of this morning would generate a total of $2.9 trillion for 2021. Personal consumption of $2.03 trillion, gross private domestic investment of $519 billion, net exports of goods and services would subtract $89 billion, government consumption expenditures and gross investment would add $523 billion. A major acceleration in growth is positioning the U.S. to capture more than one-third of global economic output in 2021. Economists continue to place the highest expectations for growth in the second quarter of 2021. Investment banking professionals are forecasting nominal growth of $400 billion and real economic output of $240 billion for the second quarter. This is a substantial amount of spending on goods and services, which may face downside risk if there are any delays in COVID vaccinations or rollouts. Under these assumptions, we would need $50 to $60 billion of spending on personal consumption expenditure in April, May, and June. I think we could see nominal growth in the second quarter of $700 billion to $600 billion, and real output is likely between $375 billion to $310 billion. For March, there is a strong possibility the $1,400 stimulus checks increase consumption similar to economic data in January 2021, which recorded a $487 billion nominal gain in personal consumption expenditure. It is also equally likely to engender significantly higher personal savings rate. We may temporarily eclipse the 20% savings rate experienced in early 2020. The higher U.S. savings rate is helping to fund larger DIS savings in the public sector, which somewhat mitigates substantial reliance on foreigner savings. The March non-farm payroll report was extremely robust, changing the recent overall trend, which had been tilted toward weaker payroll growth. Despite a strong report, there still exists 10 million Americans unemployed, a larger cohort of more than 4 million on longer-term unemployment and 20 million receiving some form of unemployment assistance. A return to 164 million U.S. workers employed may be continually undermined by the 6.5 million Americans remaining out of the labor force, which indicates large and substantial slack in the labor market. Private forecast is anticipating payroll growth between 270,000 and 500,000 per month, which equates to 3.2 million and 6 million additions to full-year U.S. payrolls. This key economic indicator is likely to pressure growth in the first half of 2021. The relative slow growth of the U.S. population, along with substantial rise in the number of workers not in the labor force, has shrunk the size of the current available labor pool. In 2020, the U.S. lost a total of 9.7 million jobs, or a job loss of 6%. To break even this year, the U.S. would need employment growth of 6.6%. Nominal wage gains topped 5% during the recession for non-supervisory workers. Although ECI, which is the Employment Cost Index, salary and wage rose 2.8% in 2020. The gain in productivity, employment compensation, and a large amount of slack in the labor market tilt towards a continuation of non-inflationary pressures as the U.S. economy grows. However, the recent agreement on $1.9 trillion in deficit spending is a significant tailwind to nominal growth in the second half of 2021 and the first half of 2022. This should increase aggregate demand, which should foster higher employment gains, but this also assumes that virus cases come down substantially by April, May, and June, and pandemic flare-ups lessen. This has led some market observers to anticipate economic overheating, which is favorable for upside risk in inflation. I believe these fears are statistically unfounded. However, I do not disagree with rising inflation as a potential risk in the short term. The recent increase in nominal Treasury yields and 5-year break-evens on TIPS, which are Treasury inflation-protected securities, towards 2.51% is transitory and likely reflecting anticipated increases in energy prices and base effects. The Federal Reserve typically subtracts 40 basis points from the break-even inflation rates, which would mean inflation expectations are currently anchored around the 2% inflation averaging metric. Following the passage of stimulus, larger fiscal savings increases capital inflows to finance very large twin deficits, which should put upward pressure on the U.S. dollar and downward pressure on corporate and government bond yields. The most recent trade data indicates the U.S. is on pace to record a real trade deficit of $1.2 trillion by the end of 2021. The current rise in yields and increase in growth expectations will likely favor a stronger U.S. dollar in the first half of 2021. This is also likely to put some additional pressure on higher real yields if growth and inflation increases are realized. Although potentially weaker inflation data than consensus estimates should allow real yields to remain deeply negative, thus providing additional support to the Federal Reserve's ZIRP, which is zero interest rate policy, and an extremely accommodating stance. Dollar appreciation also dampens import commodity-driven inflation and should lessen temporary transitory base effects. The strong U.S. dollar may have negative effects on emerging market countries with large current account deficits and substantial debt denominated in U.S. dollars. Inflationistas and inflation fear mongers engaging in scare tactics are likely to be proven wrong. However, inflation base effects are expected to be short-term. There will be some transitory spike in headline inflation data from March, April, and May. The impact on core PCE is expected to be limited. Market expectations are split, but I expect the Federal Reserve will look through these spikes. Political risks have diminished in the first quarter due to reconciliation, but it has increased in the second half of 2021 and the first half of 2022, which may pose risk to much needed investment spending on infrastructure, human capital, and research and development. So I view it in the medium term as tilted to the upside due to potential gridlock. However, there is a possibility for another round of reconciliation in the 2022 budget, combined with the removal of the filibuster rules in the Senate. This could pave the way for easier passage of additional investments-led spending, which is much needed to raise the U.S. long-term potential growth rate. Although due to political isolation, this also increases the potential for lone wolf domestic terrorism. Vaccine distribution is priced into Q3 2021, but distribution obstacles have increased, and efficacy for herd immunity will be closely watched. Redefining herd immunity may become the norm, so instead of a fully vaccinated population of 90%, we may accept a different goal post for full vaccination. Perhaps it drops between 70% and 75%. Details are currently unknown. The market is currently pricing in an additional 5.24% plus or minus up or down by June 18th. The S&P 500 could potentially trade as high as 4,608 spot 95 and as low as 3,672 spot 91 by June 18th. The Vix is expected to move 6.4%. The VIX is currently trading at 17.43. The VIX price range is 18.54 to 16.31. The skew index is elevated, which indicates market participants are paying up for catastrophic protection. These are two sigma events. Stocks continue to offer investors the highest real returns. The nominal yield on equities is 4.3%, while the nominal yield on 10-year treasuries is 1.67%. Real yields on all tenors of government bonds at the shorter end and the belly of the curve are decisively negative, but real yields at longer tenors above 30 years have moved into positive territory. Real yields on U.S. equities remain strongly positive. Disclaimer: with realized volatility near 12, there is a larger risk of systematic highly leveraged short vol strategies like equity vol targeting, trend following, and risk parity positioned for a massive increase in market exposure. The potential for a much larger move higher has increased, which a large sell-off has decreased. We are much more likely to see a fall in realized and implied volatility and a gradual melt up in asset prices. The April-May VIX contracts at 18 and 21 are fairly priced. In fact, they may now be overpriced given the new economic outlook. The passage of fiscal stimulus should juice the start of a new economic long-term cycle, which favors continued fall in realized volatility. I am temporarily moving against a large rise in implied or realized volatility. However, I have been wrong before, but sell-offs will give investors great opportunities to buy the dip. Traders should focus on cyclical sectors which tend to outperform at the start of new economic cycles. For example, being long financials, industrials, metals, mining, oil and gas, consumer discretionary, and technology. Thanks for following, and have a great start to your trading week.